It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome back to the Financial Survival Network. It's Kerry, Lutz, and stock market just seems to be heading towards infinity. But as a wise man once said, the tree does not grow to the sky, and this market's not going to either. But for a more reasoned explanation why it can't be, we've got our good friend with us, Alan Newman, and his website's been around for so long, dealing with stocks and other investment opportunities. It's cross-currents.net. Alan, welcome back. It's been a while.
Kerry, thanks very much for inviting me back on. It's always a pleasure to speak with you.
Hey, well, we like to stay current with our New York friends, you know? So the market here, I mean, yeah, we've got financial repression. You really don't have a lot of other opportunities, a lot of other places to put your money to get any kind of return. And right, to a large extent, that's what's going on. But at some point, the party's going to end, right?
Oh, absolutely. I don't think we've ever seen stocks so incredibly overvalued on so many levels. You have Tobin's Q ratio, which is the total market cap divided by the replacement cost of all traded companies. That's at 1.18, and that's the second highest in history. You have Schiller's cyclically adjusted price earnings ratio at 27.2, the third highest in history. And you're in an environment where roughly 95% of earnings of the S&P 500 constituents have gone to share buybacks this year. No wonder the S&P keeps on going up.
Hey, I heard, let me just interrupt, one other statistic that was really alarming. It was 48, and I think after yesterday, 49 record closes on the indices. And the last time we had that was in 1929. So another encouraging statistic, right?
Okay. Well, I was going to bet that you were referring to 1987, but 1929. Okay. Yes.
Yeah.
Absolutely.
So yeah, overvaluation. That's the theme. And just talk about the stock buybacks, the dynamics of that factor.
Well, if 95% of earnings have gone to share buybacks and only 5% have gone to grow the companies. So the principal plan of action is just to get the share price up, and this way they take advantage of their stock option grants for top executives. It's no wonder the job participation rate has fallen to the lowest it's been since 1978, I believe, and so many people are discouraged and no longer looking for work. This is the kind of environment we live in, and at the same time, it has sentiment as one-sided as it's ever been. The right-X ratio is at an extreme. Investors' intelligence, which is a measure of newsletter writers such as myself, is at an extreme, a bullish extreme, or an optimistic extreme. This is the kind of situation where you have major reversal.
And so here's the thing, Alan. You know, I know so many people where you got money, and quite a bit of it, some of them, and you are fully invested in the market, and you're just waiting to get clobbered. So here's the question, Alan. What do you do short of selling everything off? Because, you know, this thing could go on for quite a while longer. There aren't any rules that say just because it's overvalued, it can't stay overvalued. What do you do here to protect yourself? What's the best way to do this here?
I've always been a proponent of halfway measures because I think it makes sense. I would rather try and be 50% right than run the risk of being 100% wrong. So just for the sake of argument, I'm in a situation where I own XYZ and the company has done quite well and I want to protect the profits. So I sell a partial allotment of my position. It could be as much as 50%. Right. I'll take the profit. Unfortunately, capital gains are not what they were in terms of taxes, but I would just assume be 50% correct or partially correct. I don't want to ever run the risk of being 100% wrong.
So if you do that with your entire portfolio, all right, and then you get rid of the losers that you have so that you've offset your capital gains.
Right.
So you're 50% cash. All right. So then if there really is a huge correction, then you've got cash. And if there's some big dividend plays there, and they're secure, you're ready to go back in as well, right?
Absolutely. And let's take it to the opposite extreme. Let's say you sold out 50%, but stocks somehow rise another 10 or 20%. What is the difference? There's no way you can maximize a play when you're in a bubble. There is extraordinary risk at this point, and taking money off the table has to be a decent idea. It may not be the best idea. I mean, maybe there's some lucky guy out there who can maximize and get every single penny out of the market and sell it at the absolute peak. I'm never going to be that guy.
Reminds me of what Bernard Baruch said. He said, I got rich letting the other guy make the last 10%.
Sure.
Right.
Yeah,
so
that's correct.
And there's definitely something to be said for it. So, rather than trying fancy strategies with options and leaps and, spreads and all that, which is difficult if you're like me, if you're the average investor and somebody's got to explain this stuff to you, basically, because you're not going to understand it on your own, right? Mm-hmm. You just go for this, right? Sell half, or if it's really a great position, just get out of it altogether, right?
Yeah, and it doesn't have to be a half. I mean, let's say you were satisfied, just for the sake of argument, again, going back a year, that the S&P was fairly priced, and you sold at 20%. And then you sold at another 20% this year. Okay, so you'd be 60% invested. You wouldn't be 100% invested. You would not risk running to the bathroom and then coming back and finding out that the Dow is down 1,000 points. It's happened before. We know it's going to happen again. We know that there's going to be another crash at some point. I mean, if we keep on going in a bubble like this, you'll have a similar situation to either 1987 or 1998 when long-term capital management went under, or 2008, 2009 when we had the problem with the banks and mortgages. But, let me get to the most important point as far as I'm concerned. And when we're talking about the S&P 500, we're talking again about an index where roughly 95% of their earnings has gone to buy back stock this year. Mm-hmm. That is the most incredible statistic I have ever seen.
Yeah.
They're not concerned with increasing sales or increasing the company's strategy or a plan for the future. All they're concerned with is getting that share price up to take advantage of stock option grants.
Yeah.
That's crazy.
That's really not acting in the best interest of the shareholders, the fiduciary obligation that these.
Right.
That's nuts. Isn't it crazy? I mean, that is a really reckless behavior because when you take on debt is great, but the only problem with debt is eventually it's got to be repaid, right?
Exactly. And, there's no doubt that asset prices have been boosted by the Fed strategy, but even Alan Greenspan recently noted it hasn't done anything for the real economy. He said effective demand is dead in the water, quote unquote.
Yeah, we know that. Oh, yeah, for sure. We absolutely know that. You just have, like you mentioned prior, labor force participation rate declining and real incomes have been in a tailspin since the crash.
Right.
And those are provable numbers. They're not just numbers we pull out of our head, out of our hat. They're not numbers subject to manipulation like the so-called U1 unemployment rate, right?
Right. Absolutely.
So, and then, what do you do with that money? You just leave it in the bank and worry about it, Alan, or you buy gold? What do you do?
Well, I've been a super bull on gold since 9/11. So that's a long time back. But at the time, gold was about $265 an ounce,
right?
And it's currently about $1,200. and I really do think it's on its way to 3,500. When Nixon ended the link to the gold standard in August 71, inflation was averaging a little over 3% for the previous decade, but over the next 10 years, it averaged 8.5% per year.
Mm-hmm.
Stocks were only up 0.5%.
Right.
Gold increased an average of 26% per year.
Mm-hmm.
Over the most recent decade, gold has risen at an annualized rate of over 12%. So this implies an inflation rate far higher than the 2% we're told it is. It's probably at least 4 to 5%. And this means gold is going up. I have a 5.6 ratio a 5.67 ratio target for the Dow Gold ratio, which is simply the average ratio over the 20-year period from 1975 to 1994, which I think fairly represents the range for gold, and that equates to gold at 31.44 per ounce.
Uh-huh.
I do think 5 to 1 is doable, and that equates to 35.65 per ounce. And these targets rise with inflation.
All right.
So given my assumption that inflation is understated, my targets could be considered conservative. I think they are.
All right. And up next, we'll talk about silver, other markets like oil, and what other opportunities real estate are out there for the average investor and the not so average investor on the Financial Survival Network.
FSN Radio. It's all about what's next.
People have been using gold and silver to protect their wealth for thousands of years. Shouldn't you? That's why I go to Cloud Hard Assets. Tom Cloud has been in the business for 38 years. Call him now at 800-247-2812. Tom's service is outstanding, and you can buy with complete confidence. Order today, and you'll have your metal in your hands in 10 days or less. Tom takes the guesswork out of what to buy, and you'll buy at the lowest possible prices. And as a special to FSN listeners, you'll get free shipping and insurance. So call Tom today at 800-247-2812. That's 800-247-2812, or find him on the web at cloudhardassets.com and tell him Kerry sent you.
The Financial Survival Network. It's all about what's next.
You're listening to the Financial Survival Network. I'm Kerry Lutz, and if you just joined us, we got Alan M. Newman of cross-currents.net. And Alan's been writing this newsletter for decades now and has been a very savvy investor and made some remarkable calls on the market. Nervous right now about the stock market, but likes gold. Alan, silver, you kind of put a more volatile, obviously, than gold. And what I like about you is you're not looking at this from you're not a gold bug, all right? You're kind of what I call a versatile investor, right?
Oh, yeah, but I'd say I am a gold bug to the degree that I think gold is in a super bull market. Mm-hmm. And that said, I don't follow silver all that closely. To me, the one precious metal is kind of where I focus on. But if gold is going to go to $3,500 an ounce, certainly silver is going to climb along with it, and probably at the same rate or maybe even better.
Right. Yeah, and it's more volatile, and
right.
There's an argument to be made that it's also far more scarce than gold. 20, 30 years ago, there was 10 times more silver above the ground than there was gold. Now there's 10 times more gold above the ground than silver.
Right.
At least that's what many of the experts say, and I tend to believe it. So oil, right now, it's like getting slammed. It's in a obvious correction, but the worldwide consumption of oil, Alan, still going up. Third world wants cars. They want central heating. They want all the good stuff that the first world has. So what's your take on the long run, oil? You see it going back up again?
Well, you've nailed it. I mean, there's going to be increased demand as these economies come to fruition throughout the 21st century, like China and even India at some point down the road. But if you take a look at the chart for oil, you see the peak coincided with the peak in our economy in late 2007 and early 2008. The price slid with the economy and is sliding again, providing evidence to me that there is an economic slowdown ahead. I don't think it gets to the same lows as we got back then. It was, I think, high 30s.
Yeah.
I'd even be a modest buyer of stocks with decent dividends like Chevron. The yield's close to 4%. And it's the same thing with gold. I mean, you add to positions, you make very modest investments so that you can add on from time to time when you think the price is right. There's nothing wrong with that.
Yeah, I'm totally on board with you there because, it's just getting so hard to find new sources. The fracking boom, controversial. I think it's here to stay. It's really misunderstood by so many people as far as the ability to keep the wells pumping. I have friends in the oil patch who've really spent a lot of time explaining it to me, and it is sustainable. And I think that's what the fear of many people is, that it's not sustainable, these wells. Some of them in North Dakota definitely have short lifespans, but in Texas, these fracked wells, they manage to keep them going for long periods of time and pumping out substantial amounts. So anyways, other potential investments, real estate. What are you seeing there? I mean, aside from retail, commercial, you see opportunity there?
I don't want to be investing in retail. There is one REIT that I think has been so solid over time. I'm not suggesting anybody buy it here or even add to it, but I've owned Simon Property Group for a long time. It trades on the New York Exchange. It's done quite well. They own Roosevelt Field, which is right near me. It's the fourth largest mall in the country. But there are selective investments to make out there. It's not only in real estate, but I would think even natural gas pipelines. You have to be very selective. It's oil stocks, like I said before, with Chevron with close to a 4% yield. You can wade in and make some of these investments, certainly in natural resources. And real estate, while not a natural resource, is never going away. I mean, the land is always going to be there.
Sure.
So investments of that ilk are always going to retain their value. They may not go up over the short term, but they're always going to be there.
Yeah, and we got shortages in lots of different resources up there, in potentially in copper in the future. And so many others that you really have to be thinking about it. If you're going to play the resource sector, there's a lot of opportunities. But like right now, there's so much uncertainty. Probably better off staying with the better capitalized. The better capitalized companies are probably the best bets. But interestingly enough, some of the smaller companies are very attractive speculations now. I own IM Gold, IAG. Sure. Oh, yeah.
And Asanko, AKG.
Oh, yeah.
These companies are at what I think is rock bottom prices. So I like to add at times like this. I can't guarantee an investment like that because, again, they are very speculative. But companies like that could trade at enormous multiples at some point down the road if everything works out. And I do expect it to work out for gold stocks.
Well, you look at those companies and they've been so beat down and they're trading it so close to their net asset value or less. When a company trades at its net And it's so unfashionable now, Alan, to be a value investor, right? Value investors gotten killed over the past however many years that they seem to be almost an extinct breed, right?
Yes, that's correct. That is correct.
So really, you look at it and you say, yeah, that's, from a value standpoint, those stocks are really attractive. Understanding that value is something that doesn't seem to matter.
No, Graham and daughter are indeed turning in their respective graves.
I think they're laughing. I think they're laughing myself because they saw
either that
this.
Or they're crying. One of the two.
but they went through the Depression and they went through numerous situations like that. What we're going through now is a little bit different because the intervention, although, hey, the Great Depression, Alan, did the government really behave that much differently in the Great Depression? Think about it.
No, actually, my father was there, and I heard all the stories. He sat me on his knee, and I was a little kid, and he would regale me with stories about the stock market crash because he was a broker.
Oh, really?
And I heard about it all. And
really?
He and his father had stocks, and they just tossed them into the vault after the crash. Uh-huh. And in 1968, he kept on getting letters from asset tracers. And I said, Dad, we got to take these stocks out of the vault and take a look at what you have. Because you have stuff that you don't even know you have because they're trying to get in touch with you.
It must be worth something.
They'll find out for you and take 50% of whatever it is you have. So I took everything out of the vault in 1968 and went over it. And he had stuff like Lawyer's Title Guarantee and Trust, which went from $400 a share to $0.
Right.
But he had shares of Chase National Bank.
Yeah.
And on the back of the certificate, it said Amerex Corp.
Uh-huh.
So it was a two-sided stock certificate. Amerex turned out to be the forerunner for American Express stock.
Really?
He had $20,000 worth of stock, $4,000 in accrued dividends. One of my customers at the time was Nelson DeMille, and he put that anecdote in his book Gold Coast. It's on page 40.
Really?
Yeah.
That's a great story.
Yep.
Yeah, well, you hear about those stories because people forget about stuff. Just go look at the New York State unclaimed, abandoned property website. You see it. Hey, we got to get going, Alan. Just tell us your website, any special offers, trials, and how we connect with you.
It's cross-currents.net, and a free trial is available. I think we have a link on the front page there. I'll give you 3 issues, which turns out to be 3 months. For zilch for free. Right. And if you like it, okay, subscribe. If you don't, fine. I know we're not for everybody.
Hey, well, you tell the truth, and I like the fact that you're not locked into anything, that you'll drop stocks, go to gold, drop gold, go to oil, whatever it is.
Absolutely. And Kerry, it's always fun speaking to you.
Hey, you too. And find the link to Alan's site over at financialsurvivalnetwork.com. Sign up for a free newsletter. Alan, we'll talk with you again real soon. Be well.
Great. Take care, Kerry. Bye-bye.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.